Welcome to Cambridge House Live. I'm Bridgitte Anderson and I'm joined by Danielle Park, President and Portfolio Manager of Danielle Park Investment Council. Nice to see you again, Danielle.
Hello, Bridgitte. Another year.
Another year. So let's start off at, let's start off with 2014. What are you seeing for the overall economy?
Okay, so I think we're coming near the end of the QE phase we've been in since 2011, the last couple of years. And I see evidence of that trend coming to an end by certain leading things that we follow about some of the asset markets that have turned down since 2011, some of the growth metrics that we follow. So basically my thesis is that the commodities bubble peaked in 2008 with the credit bubble, that it's been deflating since that time. And you see that in things like, the metals, the mining, materials, all retesting their 2000 and 2009 lows in the last year. So that was part of our general thesis, that in the end of a secular boom, you end up giving back all the gains that took place over that preceding, 15-year period, let's say.
Right.
And that happened in the venture exchange, in the Chinese Shanghai stock market, in a lot of the individual sectors that support the Canadian economy. And so now we're looking for things like the dividend-paying sectors, the bank shares, the REITs, which have all sort of been higher the last year on more QE suspicion or superstition. And I think that those are now the things where the greatest price risk is for the Canadian market.
Well, and you've long been skeptical of the current rally. So let's talk a little bit more about that, because tell me what you're seeing then for that. Do you think that what do you think is going to trigger its collapse then?
Well, I guess what I'm trying to say is I think that if people look at the S&P 500 or the Canadian bank shares over the last 2 years, they think, that, wouldn't it have been nice to have been 100% allocated to just those things? And yes, that would have been great. But in reality, a lot of people have a lot of different things in their portfolio, and those were the two things that went up while everything else was going down. So I think that, when I say, you say I've been skeptical of the rally, the reason that I've been skeptical of QE is because that there is no way, in my view, that central banks can perpetually sustain asset bubbles. If they could have, they would have, and they haven't repeatedly.
Well, given what 2013, the performance then, do you wish that you had exposed yourself to more risk?
Well, obviously, I'd love to have been in the S&P 500 over the last 12 months, but that wasn't the case. Now, that said, we made gains on the US dollar, which has now appreciated 18% since we first said it was a buy. The end of its bottoming process that it completed in 2010. Broke out from there, and we've seen now an 18% appreciation. So we've been allocated there for Canadians, and that's added gains to the portfolios. Our fixed income was doing quite well. We've shortened duration. We moved out of the high yield stuff, which had made good gains. And so now we have some Canadian cash, again, waiting for, as I say, some of the dividend stuff to come back down. Another part of the thesis that I'm coming to just lately is that it's possible that the 09 bottom that was retested again recently in the venture stuff, in the metals, minerals, and mining, it's possible that that is the bottom now, that there's a rebound, from these levels. The question is, how fast will that happen? And if it's the end of a secular theme, like I think it is, you may find that it actually just sort of bounces around and makes a bottom for quite a while without a big breakout to the upside.
So Danielle, then what kind of indicators do you most closely watch?
So things like sentiment. So we know bullish sentiment, for example, is at 60-year highs today. That's a contrarian sell signal for anybody that's trying to do a rational approach. Fund flows had been negative from leaving equity funds for 6 years, and we've seen the retail investors capitulate, go back to equity funds in the last 6 months, let's say. You see the macroeconomic picture continue to deteriorate. It's interesting the way the spin comes on some of this data. So we actually had less jobs created in 2013 in America than we did in 2012. And yet people talk about the recovery picking up steam.
Well, and that was going to actually, that's what I wanted to go next, is ask you about the recovery. So you don't see it so much as a recovery by the sounds of it.
No, well, we've had some recovery in some metrics for sure. For example, consumer household debt has come down in the US, and that's a positive step. That's a deleveraging theme that had to start from the record highs. So that's been making progress. Some of the earnings forecasts remain insane at this point. $120 earnings forecast for the S&P for 2014. But you've had, so 32% gain in the S&P the last 2 years, only an 8% gain in earnings, Bridgitte. So why is that happening? It's to do with that over-jubilant feel about faith in central bankers. And I think we're coming to the end of it. I think that's why gold peaked in 2011, has been selling off. That's why taper has started. You know, the Fed picked this target of, you know, unemployment going back to 6.5 as being a marker. The bad news on that is that unemployment's going back all right, 6.7 of late, but not for the reasons anybody thought, right? For the reasons that people are falling off the work rolls. And so I think we've got whatever recovery we're going to get this cycle.
Is it sustainable?
No, I think we're about ready for the next, you know, downturn, slowdown, recoupling to the actual consumer, because they've been left out of this so much in the last couple of years. So you got a 5-year high in many indicators. You've got, you know, a fresh peak in stocks on the U.S. side, and typically that's always about as much as you get before you start to look for the next downturn. And sadly, the analysts are incapable of forecasting that. Economists are typically incapable of forecasting that. So the average person is usually left swinging in the wind just when the opportunities are less attractive than they've been in 6 years. So my strategy right now is really to not get sucked into that hyperbole, and to wait for this next clearing event to happen, because all we need is for, you know, interest rates to bump up here. Corporations have the most debt they've had. Everyone talks about corporate cash, right, at record highs. Unfortunately, they've done dumb things with the cash. They've taken the cash, borrowed it at cheap rates, loaded up, and then bought back their own shares.
Well, and there has been some discussion in Canada about interest rates starting to look like they could come back up, and then the bank kind of moved away from that, but I think that's still on the table. I mean, we're looking at interest rates as low as they've ever been. So there's only one way they can go, and that's up. And so how much of that is a concern in the near future?
I think that is a concern, but that's not my primary concern in the short run. I believe that the deflationary impacts of the aging demographics, the over-levered, still total debt to GDP in world economies off the charts, you know, that with the overcapacity, over inventories, huge inventory piles in most commodities, those are disinflationary aspects, and I believe they're still going to win the arm fight with central bankers who are trying to create inflation here. So I don't think interest rates popping up. They did pop up in the US from the bottom in 2012 on the taper talk. That exerted a big impact to the housing market in the US, and we're already seeing that in some of the recent data. So I think that, you know, the fear here is not that rates need to spike higher, it's that everybody's already fully loaded with what they can service debt-wise. Right. So you see that with corporations. They may not see a big spike up in rates, but they're still going to have less cash flow to reinvest in operations going forward. Why? Because they're servicing the debt they've taken on in this low rate environment. There's been a lot of foolish allocations of capital in the artificial environment created by the Fed, you know, trying to entice risk-taking, misallocations, not intelligent investment decisions. And that, I think, will be another deterrent to good, strong growth prospects for the next couple of years. But basically, I just want to see one more sort of reconnection with reality, one more capitulation on the belief that the Fed can control these massive global markets, which they certainly cannot. And then we're likely to get the best valuations that we'll have seen in our lifetime. So I'm actually quite excited about that because, you know, other than the S&P and financials and REITs in Canada, everything else is already going that general direction.
Well, let's talk a little bit about the junior mining sector then. There is, it looks like a pretty full show here, and there's a lot of interest. I think there has been a lot of negativity over the last couple of years, and I think, you know, looking at some of what's happening now, Where do you see that part of the market going?
I see it as much more constructive today than it has been for, say, the past 6 years that I've been coming to these shows. You know, I started speaking at these shows in 2007, 8, at the very peak of the cycle, and I've been very bearish on the commodity space because I was paying attention to the credit bubble, the China belief bubble, you know, the overcapacity, the overinvestment, all these things. Misallocation of capital was rampant back then, and there was a huge amount of people at these shows with booths and companies in the space. You know, I think we're something like 30% less today in terms of, you know, companies at shows like this trying to sell their stories. So there's been a lot of consolidation in that sector, which is good.
Do you think there's more to come though?
Well, I think that the stronger players are largely still here. A lot of weaker players have been taken out. A lot of the price risk has been removed. What still gives me some pause is that I know there's record margins still in many of the financial players in world markets. I know, for example, that the investment banks have been slowly exiting the commodities trading, proprietary trading, speculating, levering, hoarding space that they've been doing since, you know, regulations were removed in 2006 that let them go into that space. They've been backpiling, you know, all sorts of metals and inventories and artificially maneuvering prices. We're seeing them exit the space, and that's all positive, but there's still more of that to come. And so I'm a little concerned that if you get another big washout in the major markets in some of the highly levered areas, I think you'd be pretty hard pressed not to see some downward pressure still, you know, that final wash out in even this junior mining sector. But I'd have to say, price risk wise, it's a fraction of what it was 5 years ago and even in 2011, and it's very likely more value to be found here than in many of the other sectors that are still sort of on a sugar high.
All right, Danielle, thanks so much. I really appreciate your time.
Great talking to you.